Well, good morning, Bob.
Good morning, Bill.
This is FNC's Morning View, and we're getting started in January. We're discussing the new CFPB rule about qualifying mortgages. Not QRM, just QM.
Right. Well, it's been a long time coming. I mean, when Dodd-Frank was passed in 2010, and everybody's been waiting for these rules for a long time. And there are 6 other federal agencies out there that are also going to be writing rules for QRM.
Before we go into QRM, we gave a little commercial.
Oh,
we talk a little commercial. Let's have a little commercial. I've got something for the conservatives in the crowd and the liberals in the crowd. You can choose, all right? Our client conference is coming up, and we're going to have both a right-winger and a left-winger. I'll let you choose which is which, all right? We're happy to announce that we're going to have former Senator Phil Gramm from Texas, who was chair of the Senate Banking Committee and wrote or co-authored the privacy legislation. And we're also going to have retiring Congressman Barney Frank, or I guess we should say retired Congressman Barney Frank, who is the co-author of Dodd-Frank. Both will be speaking at our client conference in February. And if you would like more information, we have a website, and also see your FNC account representative or salesperson, and they'll get you an invitation. Yeah. And so you can choose whether you want to be ultra right or ultra left or somewhere in the middle. Awesome.
And those are both slightly to the right, right?
Oh, fantastic. So, having said all that, since we're talking about, you brought up Dodd-Frank, so I thought maybe we would talk about, Barney Frank and Phil Gramm coming. So let's talk now about QM and the new regulations. Give us some specifics.
Well, I mean, the idea is to protect consumers from some of the mortgage problems that we had in the past, where there were some people put into mortgages that were inappropriate for them. So the idea now is to basically ensure that they have the right ability to pay. And so they've put in a number of different requirements.
How about a down payment requirement?
No down payment requirement if they have the right ability to pay. And one of the constraints on that is that their debt-to-income ratio has to be less than 43%.
Oh, that's going to make it tough for people in California.
It'll make it tough for everybody in jumbos. You know, the idea is that you've got to have enough free income to be able to cover your mortgage payment. And
no car payments?
Well, there's got to be free after the car payments, okay? But the idea is that for lower income people, you have your living expenses are pretty well fixed from month to month. The utilities and the food and the driving and all of those types of things.
Well, it's actually quite generous. I mean, when I was coming up, this is going to date me now, the front end debt to income ratio was 28%.
Right.
And the back end, with all the debt, longer than 6 months, was 36%. That was a guideline.
Right.
And now it's up to 43.
Yeah. Of course, so for a while it was 50.
For a while there was not one.
Exactly.
Whatever you could do was, because houses were going up, no big deal.
Exactly.
And so now 43%. Let's keep going. What else?
Well, there are no interest-only loans.
Uh-oh.
No balloon payment loans.
You can't have a bullet.
Nope.
It's got to be fully advertised.
Right.
And that affects the debt to income too.
Right. Most of the loans now are going to be 30-year loans, government-backed with GSEs, and that brings into question what's going to happen with Freddie and Fannie. They're both profitable now. Are they going to keep continuing to be wards of the state, or are they going to be set out on their own?
Is that wards of the state the Mississippi term for conservatorship?
Exactly.
Okay. All right. So basically, we've got a 43 debt to income all in.
Right.
What else? No minimum down payment.
Right. No down payment thing. There's a 3% cap on points and fees.
Uh-oh.
And that's done differently whether you're a broker or a lender. Okay, because for a broker, it's all-in fees and points, whereas for the lender, there are certain fees that they can exclude from that constraint.
So on a $200,000 loan, the broker can make a max of $6,000.
Including the fees, right?
Right, so $6,000 profit.
Right.
Or I really shouldn't say profit, I should say revenue.
Yeah.
But lenders can exclude that, they can make more.
They can make more, right.
Awesome.
Right.
Keep going.
And the other thing is that on all of these constraints, there's a small lender exemption.
Oh.
Okay, so for those folks that are having a problem with the 43% or the fact that they really do need a balloon payment down the road, they could go to a small regional lender under $2 billion cap, and they can get that same loan. The negative side of that for the small lender or credit union is that they have to retain that loan on their books. Okay.
So they put it on their balance sheet.
Right, they have to, but that's what they do anyway.
Right.
Right. So it's really not that big of a constraint for them.
So any other constraints?
That's pretty much it right now. Oh, there is on the interest rate. Yeah, there's the maximum interest they can charge is 150 basis points above the base rate.
Unless it's a high, or it would be a high cost loan otherwise, right?
Right. Right.
And so that's not good.
No.
So let's step back a second and talk about that, how that affects underwriting. It probably will not have that much of an impact on the traditional GSE loans. No,
not at all. The question is, how are we going to open up the secondary market?
Well, the requirements of the GSE stuff's on the inside of that, right? I mean, most lenders are going to underwrite a GSE qualifying loan. In most areas of the country, the maximum loan amount is 417, and you're going to be on the inside of that from a debt-to-income ratio, inside of 43%. Right. So it really has very little impact on the GSE stuff.
That's correct, although what it may be doing is solidifying the GSE's control on the market, okay, because it's not giving any opportunity right now for secondary market participants. There are 6 other federal agencies that are writing rules right now for QRM, and once those are established, then there's going to be some opportunity for the secondary market to come back. And they're going to base those in large part on what the Consumer Protection Bureau developed.
One of the unique things about Fannie and Freddie in terms of investors, so Fannie and Freddie buy loans, they pool them, and they issue bonds that are backed by those pools of loans. Right. One of the unique things about Fannie and Freddie is they guarantee not only the eventual payment of principal and interest, but the timely payment to the bondholders of principal and interest. And they charge the originating lender, and therefore the consumer, a G fee or guarantee fee for that. Right. Now, one of the ways the government, in their, what did you call it, not conservatorship, you call it, you had a
Ward
name
of the state.
Ward of the state, yes, a ward of the state. In the ward of the state environment, I like that. The concept is to continue to raise that G fee, and one of the things that has affected their profitability in a good way is that G fee has gone up.
Right.
Now, many of the secondary market participants believe that that G fee, the increase in that G fee, is going to enable the return of the secondary market because it in effect increases the yield spread.
Sure, but the other issue is understanding exactly what the risk retention requirements are going to be, and that's not going to be determined until these new QRM requirements come out from the Federal Reserve and other government agencies, because once that's established, then that'll provide the structure, the baselines to create the secondary market.
The two things we're hearing in the market that's going to drive the return of the secondary market: one, the lowering of the loan limits. So they were up at 725 and now down 625, in most areas 417. Yeah. That's one thing. So anything above 417 becomes a possible securitized loan.
Exactly.
And the second thing is the expansion of the G fee, because that increases the yield spread and allows the secondary market to bring private capital back in so they can earn those kind of returns. We see very little impact on those two things in these new rules.
That's correct, although when the other government agencies step in, we don't know exactly what their requirements are going to be. They're going to use the Consumer Protection Bureau as a guideline, but in the early drafts of some of those, they had as much as a 20% down payment requirement on some of them, and it hasn't been finalized. The hope is that they will sync with the Consumer Financial Protection Bureau requirements so that they are all the same across the board.
Well, the good news here is there's no minimum down payment. So that is all fantastic. We can still do a 100% loan. We may have to go to a small bank, but we can still do 100% loan. Hey, this is FNC's Morning View. Come see us at our client conference. We'll have Phil Graham and Barney Frank. I'm Bill Rayburn with Bob Dorsey. You all have a fantastic week.